Good evening, everyone. My name is Dr. Mahendra Mehta, and I'm going to try to cover entire finance in next 60 minutes. Okay, what is my objective of doing this? And it's just an attempt to sum up key concepts of financial science in 60 minutes. I think it is too vast to be covered in 60 minutes, but nevertheless, I thought I will bring out some key principles, or as I call it, basic principles, which form the basis of everything we do in finance. It's quite one of the very new subject on the list of subjects in the world. So, and a lot has happened in this subject in last 60, 70 years. I would actually feel that this is the most fastest growing subject among all, in terms of its growth and its impact on the life in general. To try and explain the concepts in English as far as possible, I have avoided the use of mathematics totally in this presentation. So I just want to give you a concept in terms of what actually is happens in finance and what the participants, institutions, and market they do in finance. To convey, like many other subjects, finance is rapidly dependent on technology. That means the technology has become an integral part of finance in a substantially big way. To put across several emerging technology like blockchain, AI, and machine learning, and automation is increasingly playing a role and would soon become most dominant in practice in finance, in the sense that some of this newer technology has a lot to offer in financial services, financial products, financial management. So I think some of this technology will be very rapidly adopted by the industry. Also, to emphasize the role of statistics, mathematics, and computers, and how it is shaping the modern finance practice or modern practice in finance. Also, one of the objectives was that to create interest in the study of modern finance for those who intend to make their career in finance. So this was broad objective I thought I will look at. So let's look me finance in 60 minutes. Again, I mentioned that the key concepts of any subject. I actually think that we should be able to convey the summary in a short time. What is the subject really covers? What it what are the basic principles? So that was actually my objective. Challenges in covering the subject matter in 60 minutes, I think, is a huge challenge. When I started preparing this course, and I found that there are a lot of things which actually I cannot cover. So vast and varied subject matter, and I don't think that I can really do justice subject in 60 minutes. Nevertheless, I'll try to attempt to give you the broad sense of what really happens in finance. So coverage is very broad. I'm just touching most of the subject matter as it appears, and but some of the key subjects I will go a little deep into that, so that we get an idea in terms of what actually happens in this. First thing I would like to sort of bring to light is the importance of finance in our life. Every individual must learn and know basic finance. I think it is a very important thing. I myself have an engineering background, and I never thought that finance is such an important subject to learn. And I think it's important that every individual, no matter what he or she does, I think it's important that they have basic understanding of finance. It is not difficult. It is the basic finance is extremely straightforward, and and it actually matters a lot once you have the knowledge of basic finance. So that is first part. Last 6 to 7 decades, as I mentioned, there has been a phenomenal growth in finance. I think mentioned in particularly last 50 years, and has seen enormous growth, and last 20, 25 years. Technology has made a difference actually. Technological growth, expansion of internet, high speed connectivity has multiplied the growth many times. Things have become so easy and extremely well integrated with technology. How the finances really got integrated with the technology and connectivity is something amazing. Ease of geographical reach, integration of the world market, creation of new instruments, etc., also has given a lot to finance. Other aspect is easy global travel along with migration of people also has helped finance to grow. Greater awareness among youngsters, I think it is one of the most lucrative career, of all careers. If you do it well and if you understand the complexity many times of the finance, it provides the maximum number of jobs in the economy. Slow and steady decline and disappearance of communism from the world actually. So the modern finance, in my mind, has also helped slow and steady decline of communism from the world, which is quite interesting. So it has actually made difference in politics. It's quite interesting that if you look at what is China and what is happening to China, post opening quite a lot of aspect of financial market. If you look at entire Eastern Europe, look at Russia and a lot of other countries, I think they are good examples of how finance has penetrated their world. The first concept which I actually want to emphasize is the time value of money. This is one of the most dominant concept behind working of finance. A dollar or rupee today is always worth more than a dollar or rupee tomorrow. The reason is the interest rates are positive. Generally, they remain so, except if you look at scenario today, US dollar, euro, Japanese yen, British pound, Swiss franc, Australian dollar, all these currencies actually have been having all-time low interest rate, almost touching zero. As a result, the future value and the present value is almost the same actually. So the time value of money is now is sort of quite different as compared to when the interest rate are actually positive, of course, and they are actually of the order of 3, 4, 5, 6, 7%, whatever actually is now, single digit only, but around 5, 6%, which actually has been the case. The average interest rate, if you go back to 100 years, has been 3 to 4% in dollar. And if you look at rupee, it's the all-time low interest rate in Indian rupee also. So we calculate the present value of the future cash flow. That is one of the important tasks we do in finance. And of course, the future value of a present cash flow. So these are the two tasks, depending upon the situation and the problem we are trying to solve, we actually compute these numbers. Most important concepts of financial calculations. Implicit present value. This is an important concept. All the pricing of any financial contract has implicit present value concept built in that pricing. Quite important to remember. The present value you price an futures contract or an options contract or a bond contract or a fixed income or a derivative contract. It doesn't really matter. It has an implicit present value concept built in. Primary basis for entire decision making in the financial world. So the time value of money is the primary basis for entire decision making in the financial world. No matter we do pricing. Pricing is one of the important aspect of the financial markets. When we want to sell or buy a particular financial instrument, generally I'm talking about either the marketplace prices it for you or somebody sitting on the other side prices for us. Then once the pricing is done, we need to value it, because if the contract lies in our books for a period of few months or few weeks or days, then it has to be valued worth how much it is actually. Either it is valued by the exchanges if you take an exchange traded contract, or if it is an over the counter contract, it is actually valued by the person who has sold it or who bought it actually. So when you are doing this, then we also have actually another component in the where the time value of money is important is the risk management. Risk management actually is in the financial market has been a relatively recent phenomenon actually, because the risk management was not so much integral part of the financial services, because historically the risk has been extremely low except the credit risk. The other components, the risk has been low, but in recent last 20, 25, 30 years, maybe 40 years, the risk has actually suddenly has emerged and it has become a dominant part of the financial market and financial activity. Then we're looking at arbitrage. Arbitrage is something which, sort of is also figured using time value of money. Lending, I think, is time value, borrowing, derivatives pricing, valuation, derivatives risk management, everything. Each of these services or functions have really time value of money component built in this. So the first and most important point in the finance is time value of money. So this is, relationship, basic relationship among variables. So when you look calculating about time value of money, there are 4 parameters. One is the interest rate, the second is time, third is present value, and the fourth is future value. So the equation, I think, is very simple. The future value is equal to present value multiplied by 1 plus interest rate divided by the compounding period or compounding frequency, and to the power interest rate into time. This is the basic compound interest equations. And if you actually, this is a discrete domain. If you go into continuous domain, it simplifies itself a lot. Future value is equal to present value into E is exponential, which is 2.7124, whatever actually, to the power interest rate into time. This is the relationship between future value and present value. This is what actually is I think the most important equations. And you look at the continuous time finance is used in when we actually are pricing options. So that's something which actually options are dealt in the continuous domain and not in the discrete domain. So that's what the continuous domain equations become actually relevant. The relation to the interest rate itself, one of the concepts which actually is defined as term structure of interest rate. Term structure of interest rate is a two-dimensional graph or a function which on the x-axis we actually plot the time, on the y-axis we plot the interest rate, and it shows the relationship, time varying relationship between interest rate and time. So the interest rate plays an important role in the financial market. It's an integral part of the financial calculation. The interest rate are, now this is important, are tenor dependent, probability of fault dependent, currency dependent, sometimes purpose dependent. So these are 4 important things. And interest rates are, as we know, largely determined by inflation, growth, and several other economic factors, which are actually generally sort of interest rates are determined by the central bank in any country, and marketplace also actually plays key role in terms of what's happening to the economy. So these are something which actually interest rate is a sort of an important, most important single variable which affects the financial market in significantly big way. All financial markets, all financial instruments, all happening in the financial market actually is somehow related to what happens in the interest rate. So I have actually plotted the interest rate for Indian rupee, and this is the curve as of today. So you can see clearly it shows the interest rate for different tenors, almost going up to 30 years. And you can see the interest rate is almost flat from 16 years to 17 years, almost to 30 years. So somewhere here, actually, it is quite flat. And here you can see sharply 3%, and then between 0 to 1 year, it's actually quite low, and then it starts to go up rapidly. Rapidly in the sense that there is upward sloping, and then it goes and becomes flat actually. So this is typical this thing. If you look at dollar yield curve, it will be actually somewhere here, somewhere here. Almost you can look at 30 years it's trading at between 1.5 to 2% actually. So that's what has happened to the dollar interest rate because of the a lot of factors, and I think the economy is now struggling because of a lot of external internal factors, and one of them is, as you know, we are all going through a difficult corona period. So the second most important basic principles of risk and return. So after the time value of money, the other important point which I would like to mention is the concept of risk and return in financial services. Whatever we do in finance, so the financial risk and return must be seen in relation to each other. The risk and the return generally cannot be separated. So we actually are trying to see, they are generally directly proportional, you know, but over a period of time, if you actually, as you increase the risk, the return starts to taper off. And that actually is, so that's the sort of relationship between risk and return. The financial risk and the return, financial risk, it's actually faced by all participants, no matter what financial transactions are undertaken. So if you look at the financial transactions which are actually undertaken by anyone in the financial market, the everybody actually faces some kind of risk. Risk in finance is now becoming a quantitative measure. Earlier, they were actually looking at almost had a qualitative measure actually the risk, and one of the biggest risks the financial services took was what we describe as a credit risk, and they were actually looking at qualitative measure in terms of, as we see very clearly in the S&Ps and Moody's, and these people actually, when now they're talking about triple A, double A, B, triple B, that is a qualitative measure actually. But now recently the risk is now being measured quantitatively, and risk variables actually, return variables are contextual in the sense that contextual, because what I'm implying here is that if you're looking at return from the investments, return in a company, return in a hedge fund, so they are actually quite risk return relationship is quite different, and so return and risk has to be seen in the context. So that's something you should be kept in mind. Risk is not easy to define. The risk mathematics or risk management, risk measurement is fairly new. So we are talking about 30 years. And the credit risk, market risk, operational risk, liquidity, all that actually part of the risk management or risk, measurement generally. So all these risks are being measured using what is known as a statistical procedures. So it is what we describe as a statistical estimate, and it needs a good understanding from the point of view of when you are actually looking at the risk in a financial transactions or in financial services or in any financial activity. We need to understand the risk component pretty well, the scope of estimating the risk, and the limitation, how the risk is being measured actually. So that is something which is quite important to really understand. So that is something which should be kept in mind. Then we are actually looking at, when you are looking at the risk, we also need to understand assumptions behind the risk estimate. What are the assumptions which has gone into measuring the risk? Because generally we find that we are making simplifying assumptions to understand the risk, and those simplifying assumptions sometimes give rise to limitations in terms of its measurement actually. So the financial risk generally is measured in terms of a potential loss amount. So that's what we are actually looking at. A potential loss amount is generally measured in dollar or rupee, and the other possibility is that you can make a relative measurement in terms of percentage, and then it is measured at a certain confidence level. Now, confidence level is a statistical measure. You say that whatever risk measurement is being done is 99%, 95% confident that the risk estimate we are making is X dollars or whatever actually. And then when the risk is measured, the time axis is important. I'm measuring the risk in 1 hour or 1 day or 1 week or 1 year. So that's something. So there are multiple dimensions to risk measurement actually, and this must be kept in mind when actually measuring the risk. So that means, just to summarize, dollar percentage confidence level and time. Also, the leverage actually. So there is a concept of leverage. I think it's important. The financial leverage must be understood. What actually is leverage? Leverage is nothing but, in the sense that you have a small capital and you are leveraging that capital to, create assets which are much, maybe 3 times, 5 times, 10 times more than what actually is the capital actually. So that means what you're doing is you are actually borrowing based on that capital, and you're leveraging your capital and creating assets from the point of view of, creating leverage so that the return on assets can actually go up and return on equity also can actually be enhanced. So the risk has to be considered as, risk and return in relation to the leverage, because leverage actually magnifies the risk, something which actually is. So the concept of leverage is also quite an important sort of part of risk and return. I think this is one of the most important slide, I would think. Risk transfer capability of modern finance. By far, this is one of the very big achievement and contribution of modern finance. I would actually think so. Huge ability of modern finance to be able to transfer risk from someone who does not want to someone who is happy to take risk. Before existence of the financial market in the shape we see it today, there was absolutely no chance that somebody has financial risk and he or she wants to transfer it to someone in the marketplace. That possibility was not there. So one of the biggest innovation of the current modern financial markets or financial science is ability of governments, corporates, fund managers, financial institutions, individuals, insurance companies, no matter what we're talking about here, what counterparty or what institution we are talking about, they have today they have an ability to transfer their risk to someone who is willing to take it. So this actually power of modern finance is, I think, one of the most important thing in my mind when you're talking about what is the modern finance is all about actually. So I think, as I mentioned, that every activity has risk, and that activity actually, once you measure the risk, and if you don't have that appetite to take that risk, you can actually transfer that risk to the marketplace or to other counterparty. That is, I think, quite an important aspect or of the financial market really, or the financial science, to put it this way. Financial system also inculcates trust in one another. This is another very, very big actually component of financial system that has been another very big contribution of finance. If you look at Visa and MasterCard, it's actually they trust you and they give you the card, they give you credit. So it's actually the trust relationship between the service provider and service recipient. So that's the trust which actually has been created by the financial instrument called credit card. The other big thing actually is central bank's ability to smooth out economic cycles as and when required. So the modern finance or financial tools, financial system also allows central banks to smooth out economic cycles as and when required. So that's something which actually is also quite an important contribution of of finance. Also created trust in the world in terms of capital transfer and breaking down of communism, as I mentioned, from many countries around the world. And I think I mentioned this earlier, changing the world order in many ways. This has been one of the very, very big contribution of the finance. As a result, the frictions, which is quite different, if you go back years or decades ago, has reduced considerably. All the different kinds of frictions, the competition and a lot of other things which actually has emerged. But if you look at China and Eastern Europe, they have actually recognized the strength of the modern finance and its activities, and they have adopted in many ways some of these things. The other aspect is the profitability and liquidity. This is something, profitability is measured by return on assets and on equity. So what is the return on assets and equity? So, if you look at the return on assets, it's an important measure of performance of the capital. So when you deploy a capital in any business or in any activity, we are actually looking at the return on assets and return on equity. Actually, these are very common measures, irrespective of industry, irrespective of investment you make. And so these are all two very, very big measures in financial sort of science or financial activity. Liquidity is another very important subject matter in finance. Liquidity is defined as how easily an asset can be converted into cash without affecting the market price. So there's something which actually is the important function of liquidity. And liquidity is again another very, very important point in dealing with the financial market, in dealing with the financial science, because liquidity is paramount to some organizations. Particularly if you look at what happened to Lehman Brothers collapse, I think it was lack of liquidity. If you look at enormous amount of financial services, particularly banks and a lot of large financial institutions, they have to make sure that they manage their liquidity well. Again, so that's why I've written here, the liquidity is an important in finance. There are some rough measures of liquidity measurement and management. Now, again, liquidity, like risk, is also, it's a complex sort of entity, and it cannot be easily measured by, deploying some simple statistics or mathematics or set of equations. So that is something. So there are some, rough measurement in terms of creating some ratios, and based on that, actually the liquidity is measured. And what has actually happened in the past, those ratios are taken that yes, if you set to have a good liquidity if certain ratios of of certain variables in the balance sheet, or is actually meeting certain thresholds. So that is considered as the good liquidity measurement. But again, lot of actually, so these are some of the very rough measures of measuring liquidity actually. But nevertheless, I think liquidity has to be more scientifically measured and managed in organizations as compared to what actually is being done. So the liquidity measurement, profitability measurement, these are all again very, very important functions of finance. Cash, bonds, and stocks are considered liquid. So these are some of the things which are considered extremely liquid. The bid offer spread, that is the price difference between buying and selling, spread is a good measure of liquidity. That is, low bid offer spread means high liquidity. So if you take an example, the foreign exchange market is said to be most liquid market because the bid offer spread is 0.0001. So you can see exactly 0.01% is the bid offer spread. As a result, is considered the most liquid because the depth of the foreign exchange market is very, very high. So generally, liquidity actually is an important variable, and it must be considered when you're looking at the measurement or management of finances. Prudent liquidity management is key to any business. So this is something which actually is important. Then the other thing I'm actually looking at is the principle of diversity. I think diversification is one of the very, very important thing in finance. As the popular phrase goes, do not put all your eggs in one basket. So when you put all your eggs in one basket and something happens to the basket, then chances are that all eggs will break. And as a result, that diversification is an important attribute in finance. Whether it is investments, whether it is customers, whether it is instruments, whether it is tenors, whether it is markets. And these are all some of the attributes where diversification is important, because, what is the beauty of diversification? The moment you are diversified, what actually you're doing is you're reducing the standard deviation or reducing the volatility. So that's something which actually, because if the correlation is not high among the asset classes or whatever actually we are considering, then the diversification does take place. And once the diversification takes place, the volatility or the standard deviation of the portfolio actually starts to drop, and that actually helps us to reduce the risk, because risk is nothing but a measure of standard deviation. So if you look at statistical measurement of risk, it's nothing but standard deviation actually. So if the standard deviation is zero, then we're talking about there's no risk. And as the risk starts to become more, because the standard deviation has increased, which actually in terms of financial market we name it as volatility. All right, so that's an important measure. And the diversification has to be a measurable quantity. It's quite important that we should be able to measure the diversification. And the statistical correlation. Correlation is one of the measure for diversification actually. So generally, this is, correlation measurement is generally, used to measure the diversification. And here I'd like to sort of point out the correlations are incredibly deceptive measure, because the correlations actually, can change very rapidly. And if it changes, it gives you a wrong notion of diversification, because so that's something one has to be really careful. Most of these statistical measure, they are incredibly unstable. And when they become unstable, it gives rise to the problem, to the underlying theme, because the mathematics which is actually being used or deployed in measurement of the diversification or risk or return or volatility or all that actually are very, very rough or coarse measurement of these things. So one has to really very clearly understand what exactly you are trying to measure and how you are trying to measure, and what are the limitations of each of these measurement actually. So that's something which is quite important. This point of time, I will actually, maybe next slide I talk a little bit about another important aspect. Yeah, I can talk here. During the market stress, the diversification generally reduces. Now, this is quite important. Actually, what really happens to that diversification when there is a stress in the market, the diversification starts to give up. When something is falling and there is a stress, something else which is not correlated also will start to fall. As a result, when you need the diversification the most, you don't get as much actually. One of the things which happened in 2008, we found that because there was a problem in the financial market, and we found that most of the risk management apparatus which was used to measure risk utterly failed. And that is the time the risk management got tested fully, and we found that it was not able to give a correct answer. And the risk was although being measured, but it just couldn't really handle it properly. As a result, the next set of sort of regulations actually came, and one of them was stress testing. It actually became reality because the risk management, which actually takes the or 2 to 3 standard deviation. We are measuring the risk at 2 to 3 standard deviation, which is the normal movement you'll see in the financial market for any underlying. But what we found is that the movement was 6, 7, 10 standard deviation, and that was not expected from the financial market. As a result, now we are looking at seriously some of the conditions where stress test is actually now become an important theme in the financial markets. Another important aspect, which I think partly we have discussed, was hedging. Hedging is nothing but hedging is a process of risk management. You can say risk reduction. In the sense that when you actually are hedging a particular financial exposure, you are actually trying to reduce the risk to an extent which you think comfortable actually. Ability to hedge a financial risk is an important contribution of modern finance. I think I mentioned this. When you are able to transfer risk from one entity to another entity, that is something which actually is one of the biggest achievement of finance. Hedging risk management strategy to an acceptable level, which actually is another important attribute, results in lower returns at lower risk. So the moment you start hedging, you'll find that your returns also start to drop because you are now taking a lesser risk. Hedging, whether in the portfolio or businesses, is about decreasing or transferring risk. So the hedge is that this helps to protect the portfolio businesses for future from future uncertainty. So what actually happens is that there's a uncertainty, and whatever you understand of uncertainty, or we understand of uncertainty, there is a greater amount of uncertainty you expect, then you would like to hedge so that you can actually protect your portfolio or businesses. Besides protecting, it also helps in making market more efficient. Now, this is also a very important attribute of hedging. Hedging must also be measurable. It's important that we should be able to measure the hedge in terms of how well we are hedging and how efficient or effective the hedge is. Same as very similar instruments. So normally what happens is the hedge is actually used, normally a derivative transactions or derivative instrument or product is used to hedge. And it is a similar instrument instead of, if you are a long and underlying, then you actually short the derivatives or whatever actually, so that you have a full hedge or a partial hedge, whatever you want to do exactly. So if the hedge is improper, it will maybe give rise to a basis risk. Hedges protects profit, it mitigates losses, it actually portfolio value protection. And as I mentioned, normally a derivative instrument is actually used to hedge any particular financial instrument or portfolio or anything actually. So this is something which actually another big area of finance is corporate finance. Now, corporate finance is basically it's relatively big area because the corporates, they actually use the financial services in fairly easy way. Actually, I don't think they have generally a lot of complexity surrounding their financial services or need of financial services. Generally, they have funding needs and they fund their businesses either using debt or an equity or suboptimal combinations of debt and equity. So they have capital structuring, which is, they see exactly what is the best way to structure their balance sheet in terms of debt and equity. And then they have to make investment decisions in their businesses to see whether, their assets they are creating is actually worth the return which they are actually expected to give. So that's something which, so there is, I think the finance part is generally straightforward, but sometimes they do use financial instruments, derivative instruments, particularly to hedge their foreign exchange risk or interest rate risk, or if they're taking commodities, then commodity risk, or anything else where actually their exposure or their risk level is very high, then sometimes they go to the marketplace and use that actually. So corporate finance is primarily concerned with maximizing shareholder value through long and short-term financial planning. So that's the corporate finance. Again, then prudent implementation of various strategies in terms of structuring capital, investment decisions, and making sure that the undue risk, financial risk, is not taken in the balance sheet. And as and when they see interest rate risk or commodity risk or foreign exchange risk or any other types of risk, actually, they go to the financial market and transfer that risk to someone who is actually better able to manage this. So that's the corporate finance actually works. Then another important activity which actually happens in finance is an investment. Actually, investment, I think, is a science and an art in finance to identify and invest in assets with a view to generate income or appreciation. So either you have a regular income or you have an appreciation of the asset, so that when you sell it, you have capital gain. So that is where I think you are looking at. So the important requires fundamental study of asset classes and opportunity offered by them. So here you can deploy whatever, equity research, fundamental research. You're looking at industry, you're looking at government regulation, you're looking at various other aspects whereby next 5 years, what's the government view or what is the need in the economy, how a particular company will grow and not grow and things like that. So that analysis is made, and based on that, the analyst will actually identify some good investment possibilities, and based on that, they actually make investments. So this is one kind of investment. So keeping in mind taxes and other government regulations, they're also actually one of the important attributes. Interest rates and expected volatility are also, important attribute, how the interest rates are likely to see in the future. So that these are again important decisions in the investments. Most important impedance in okay, now this is an important point which I actually want to make here, that if sometimes we get asked what really drives the innovation in the financial market. It's a very interesting question actually. How the innovation in the financial market takes place. What drives the innovation in the financial market? And I think one of the very interesting answer was taxes and government regulation. 90% of the financial innovation has come because of the changes in taxes or tax policy, sort of, tax policy regulation have changed, and the government regulation towards the financial markets actually has changed. As a result, the financial market or financial institutions or financial services, they start to innovate and to see exactly how to circumvent the taxes and government regulation to see if the taxes can be minimized and the government regulation can be surpassed somehow actually. And this is quite interesting actually. Generally, investments are generally medium and long term. So this is where the investments are actually there. Again, we are looking at return on assets, return on investments. These are some of the key things. Again, time value of money is also an integral part of the investment. So this is something which actually is more important. One of the things I'm looking at is the financial market. So now from some of the key important concepts, I'm moving to financial markets. So the financial markets are the nerve center of finance or financial activity. Because anything we want to do in the finance, you have to necessarily go to the market. So major advancement in finance is the creation of financial market. And I think there are, in last 20, 25, 30 years, the amount of financial markets, almost like 30, 40 countries, the financial markets are extremely active with lot of instruments traded, and particularly the financial markets are extremely active in US. Then you look at in UK, and then in India also financial markets are relatively active. Singapore, Japan, Korea, even China, Australia, Switzerland, Germany, France. These are some of the countries where financial markets are extremely active. Also, then top of that, internet communications and proliferation of computers played pivotal role in advancing financial market. As I mentioned, without the technology as we see it today, I actually don't think the shape of the financial market would have been what we see today. It has made so much difference in every activity in finance that's mind-boggling. I don't think that any other science or any other thing we see in the market today has made so much difference as much as the technology has made difference to the finance or financial markets actually. And so the activities which financial markets really provide is price discovery, reduction in arbitrage, increase in efficiency, capital raising, investing, risk transfer, hedging, risk management, liquidity provider, asset valuation. These are some of the key things which a financial market really provides. So the financial market actually is one of the most important thing in the financial activity or financial services. Broadly, there are two kinds of financial markets. One is the exchange traded, which is actually managed by the exchanges, and they have standard instruments which are actually being bought and sold. And then you have OTC market, which actually is so you go to a counterparty and they sell and buy an instrument from you. Generally, either they are banks or non-banking financial companies which actually get involved in the OTC contracts. But otherwise, I think exchange traded market is actually expanding, and quite a lot of transactions, particularly in the bond and equity particularly, they are very, very active actually. More and more financial instruments are being traded in exchanges because exchange, the credit risk is not there, the liquidity is very high, the transparency is there, and And there are a lot of advantages, and the chances of default is almost nil. Till today, no exchange has defaulted. No exchange has defaulted in the world actually. So when you do something in exchange, you are you know exactly that things will happen as you require them to happen actually. So the financial markets again are quite important part. Going further to the in the financial market, you have several types of financial markets. You're talking about capital market, which is equity market, generally local. So equity markets are generally local. That means the local shares are traded. Some markets are more widespread. Now, if, for example, if you look at US market, the lot of things from the world are actually traded in US market, and many other market, like a lot of equities of Indian companies are also traded in Singapore. Some of them are traded in New York. So and maybe in London. So some of these are equity markets, but generally they are local. Bond market is also very local. Interest rate market, bonds, and other fixed income, they're also generally very local actually. Then money market is a wholesale market which is extremely local, and wholesale market for short-term borrowing and lending. So this is generally a very local market, and this is where I think the central bank and all the interbank market activities take place in a big way. Then we are talking about commodities market, which is also fairly big, where futures and options, they are two derivative instruments, they are traded actively. Foreign exchange market is another very, very big market, which is generally global, and it's open 24 hours, except I think, Saturday or maybe Sunday actually. Saturday is sometimes the, markets are open in some of the Middle East countries, but generally the markets are 24 hours and it works. And then derivative markets, there are derivatives which are traded in each of the market: interest rate market, money market, commodities market, foreign exchange market, equity market, and bond market. So the derivatives is a much bigger market actually in the financial segment. Then we are talking about financial instruments and financial products. Financial products and instruments are again very important element. This is where quite important we need to understand all transactions. Now this is an important statement I'm making. Undertaken in financial markets, banks, financial institutions happen necessarily using a predefined financial instrument. So they have a predefined financial instrument. You go and deposit money in the bank, they have a completely predefined financial instrument which allows you to deposit some money in your account. It's very, very well documented, and you can have a look at this, what are terms and conditions of that instrument. So they have all that. You go to financial market, you go to bank, you go to financial institutions, everything you are doing, interacting, is with the help of a financial instrument which is clearly defined. Equities, bonds, commodities, oil, energy, metals, pulses, foreign exchange, all sort of currency pairs are actually traded. They are all standard instruments which are well defined. That's something you need to. Then we're looking at several cryptocurrency markets which are now in India. They are not still allowed, but I think in many markets that has now become quite a reality. They are being traded. Very big derivatives market in all above underlying. Exchange traded, and it should be OTC actually, not OCT, but OTC market, over the counter market. Exotic derivatives in the OTC market actually. So these are some of the financial products which are very actively traded in the financial market. So overall, if you look at this, what do we do in finance? So let's just summarize, and this is an important slide. So if you look at, one of the prime activity we do is lending and borrowing, and that happens in the money market and in the borrowing market, in the capital market actually. So for example, corporate institutions, interbanks, and you also banks normally, individuals, corporates, they actually borrow money from the bank or financial institutions. So there is a huge borrowing activity which takes place. When you borrow money, so there is an instrument, and different kinds of borrowing configurations are there. You actually borrow short term, or you are actually borrowing to fund your short term expenses. So there are different definitions of borrowing, and that is, but in total all you're doing is you're borrowing. When you're borrowing, you're paying certain amount of interest, as depending upon how you use the money and how long you use the money. So there is an interest associated with that, and the time is associated. And I think in the starting, I actually wrote a formula on that basis. The interest is calculated, and you just return the money once the borrowing is over. So that actually is one of the most important financial instrument in the entire financial services, borrowing and lending. Traditionally, if you look at the biggest widespread institutions are banks, which are actually nothing but lenders. They actually take depositors' money and they lend it to the corporate or small businesses, big businesses, individuals based on that. So, borrowing and lending is one of the key functions in finance and most dominant part of finance. The second most important thing we are doing is buying and selling. And buying and selling is in cash. So, which is some activity which is taking place now. That means the asset is purchased or sold and the cash is exchanged one way or the other. If you're selling something, you are actually you'll get cash. If you are buying something, you'll have to pay cash. That's simply buying and selling. Either you're talking about stocks or a bond or a commodity or foreign exchange. So that happens in the cash market. But what really happens is when the volume becomes very, very big, eventually the buying and selling shifts to what is known as the futures market. Because, for example, let's say that you want to buy 10 million barrels of oil, you can't go and there is a mandi in cash or anything. You just can't go and buy oil of 10 million barrels actually. So you have to really do take a delivery sometime in the future. So you take a delivery or a futures contract actually. As a result, this is where I think derivatives actually, future is nothing but a derivative. Now, what happens? What is future really? Future is a very simple contract. What happens is instead of buying today or selling today, you are actually shifting the time axis. That is what is you're doing. That's it. There is no other thing which is going on. So the moment you shift the time axis, it becomes a derivative contract. So you are created a derivative instead of giving cash or buying today or maybe tomorrow at T plus 2 or 1 day from now, you are actually buying 1 month, 2 months, 3 months, 6 months to 1 year. So you actually buying sometime in the future or selling sometime in the future. And that's nothing but a futures contract. And that has become a derivative contract. So sometimes we think that derivatives are complex, but once you understand what is going on, then they're not complex because you see exactly what you have done. Instead of buying today, you are actually shifting the buying process sometime in the future. And that's what is the derivative contract, one form of derivative actually. So now derivative actually can be on account of speculation or can account of consumption or on account of trading or investing and a lot of other, or maybe, hedging. So there are a lot of possibilities which actually can take place and you can buy or sell a futures contract. All right. So there are two kinds of derivative contracts. One is non-contingent. Non-contingent means when you sign a futures contract, you have to take the delivery unless you close the contract before it matures. So when the time comes, you exchange your money with whatever actually you promised to buy. So that is nothing but a non-contingent. It's a binding on buyer and seller to deliver and receive that contract. And that is what actually we are talking about is the non-contingent. And there are other forms of derivatives which are nothing but which you call options, which are asymmetric contracts. So futures are symmetric contracts, and then contingent contracts, which are like options, are what we described as a contingent contract, where the transaction will only take place if the buyer of the option likes it and he or she is economically or economic sense it makes for her or him. Then only, so it's a contingent based on something happening in the future. So that is what exactly. So that is where I think it is one of the important distinction to understand. So anything which actually where the time axis is shifted becomes a derivative contract, and derivative contract can further be classified. One is sell category, the other is buy category. When you have a call, you are buying something. When you have a put, you are selling something, and a futures you can buy or sell. So that is what is a contingent claim or contingent product. So that is what actually, and one of the very, very big innovation in the financial market has been the creation of futures contract. I think it was a path-breaking, sort of innovation where once the futures actually came to exist, I think a lot of things changed in the financial market. And then subsequently, immediately after that, the options were announced, and options were actually traded, although prior to the announcement of the Black and Scholes equation. But once the Black, Scholes, and Merton equation came, the pricing of options actually became quite sort of straightforward. And there are of course, that was, I think, one of the very big innovations in the financial market when the 1973, when Black and Scholes, they announced their research finding in terms of how to price a call option. So that is something. So these are some of the innovations which actually happened in the financial market. And then, so now let me ask you, what is the main commodity we trade in the financial market? What do we trade? We trade money? No. We trade dollar? No. We trade risk. This risk is our commodity in the financial market. Risk. We actually, day along, morning, evening, afternoon, everybody actually is dealing with the risk. All financial services is something they are actually looking at risk at all the time. And that is their, bread and butter. They are risk takers. When they find the risk is far too high, they have an ability to transfer that risk to someone else who can manage it better or who wants to run it the way he or she feels. The other important thing is the liquidity management. I think is an important part of the entire finance. The liquidity management is nothing but cash management. You make sure that you have the liquidity which actually is needed for running the organization at all time. So this I think is the. So in conclusion, I would actually say the finance is primarily based on few concepts: interest rates, time value, interest rates and time on future and present value. I think this is a critical concept. Understanding and managing various kinds of risks, suitable risk taking and transferring through financial instruments, optimal risk taking given a reward, measuring risk or risk reward relationship, if you like to say that way, liquidity management, that is cash flow management, optimal cash flow, and then riding volatility in assets, sometimes exploiting it. So you have to see exactly, how the volatility, if it can harm you, then essentially how do you ride that volatility? And then, of course, the other rule is the adequate diversification and prudent use of technology when required. So this is what actually is something which I thought I will share some of the important facts about finance in 60 minutes. So I think I've just it's 1 minute left. So what I'll do is I'll open. Anybody has any questions or comments, I'm quite happy to answer that. But yeah. Anybody has any question or any comment? If they can also write comments on the chat, if they want to say anything or anything, I'll be quite happy to answer. Or otherwise, I put my email ID here. You can actually send your questions, and I'll be quite happy to answer that. Actually. All right. I don't think there are any questions coming. Okay, thank you very much for spending 1 hour with me today on a Sunday. And I hope please take care and look after a difficult time. I think I hope next few months things will become normal and life will is required to come to normal. Actually, now I think we had enough of this. Thank you very much. Thank you, all of you. Thank you. I will log out.